Did you basically walk away from that thinking, okay, employment's off our worry list for right now?
Yeah, for the month. I mean, it felt like a pretty stable month. The unemployment rate itself holding kind of stable, decently positive on the payroll employment growth, given the context of where we've been. So you never want to make too much of one month, but it wasn't a worry point for sure.
Well, a couple of months in a row now, we've had decent job creation and an unemployment rate that is basically stable. So is inflation the main danger right now?
I've been feeling that, as you know, Mike, I'm optimistic fundamentally. If we get some progress on inflation and we show we're headed back to a path of on our way to 2% inflation, I'm optimistic rates can go down. We just haven't been having that now for some time, and that makes me more concerned, and I'm less optimistic. We've been above the 2% Fed inflation target for 5 years, and we were at least making progress for much of that time. Last year, we stopped making progress, and the hope was the pause in progress was going to be temporary as the tariffs increased cost one time, and then went away. That we would add now an oil shock on top of things before the other went away, so we're not really sure if or when that part's going to go away. I think, for me, makes inflation that's the topic of the moment. We got to get some clarity.
Well, where do you stand on the bias debate? You didn't join in. You weren't a voter, so you couldn't vote to dissent. But do you support? Are you sympathetic to that idea?
Look, before I ever got to the Fed, I was always a little publicly skeptical about the value/appropriateness of using forward guidance to begin with, saying things that the committee doesn't think it's going to do X thing for some number of months, or committing itself to actions well in the future. I think that can be unwise to use at moments where we're not at the zero lower bound. When that kind of behavior really started when we're at the zero lower bound, when you can't change the rates. Now we're not in that circumstance. I usually don't get too worked up about the exact wording of the statement of this kind of form, because we don't know what the conditions are that the committee is going to be facing even at the next meeting, much less multiple meetings in the future. So let's just take a step back and take a deep breath. To the extent that incoming Chair Warsh says he wants us to think about communications in the statement, he's expressed some, not regrets, but some reservations, let's say, about the use of forward guidance. I'm pretty sympathetic with his view.
Well, was a decision by most people to leave the bias statement in as it was, basically sort of not tying the hands of the incoming chairman?
I don't know. You know the rules. I'm not allowed to. I can speak only for what I think, not for what anybody else thinks or what's behind their votes. I don't see how you can look at the current situation and, at least to me, view that the only thing that's on the table conceivably are rate cuts. Inflation's been above the target for 5 years, stalled out, progress stalled out last year. In the last 3 or 4 months, you've seen it deteriorating. The inflation rate is rising. The new data that are coming in are worse than the months before. And you're seeing it in categories where it's not supposed to be if it was just tariffs or oil prices, like core services inflation. So I'm still hopeful that that's going to prove temporary, but if we start to see a deterioration of inflation expectations and the unemployment rate and the job market look stable, I think for all credibility of the Fed, we have to be paying attention to the inflation rate when it's deteriorating and going the wrong way.
Well, let me ask you about what you think of expectations right now, because in his last press conference, Jay Powell noted that we'd had this series of supply shocks and that people were maybe getting used to the idea that inflation is normally this high.
Yeah, that's bad. I mean, if we start to see that in the data, as you know, we've got a long history in the United States and in other countries, that if people begin assuming that inflation is going to continue at higher than desired rates, it becomes a lot harder to get rid of the inflation. And it puts the central bank in a lot tougher spot.
Do you think that's what people are thinking these days?
I hope not, but in history, when the price of oil specifically, price of gasoline, very public price, when it goes up, there is a lot of consumer level expectation that responds to the price of gasoline in kind of an outsized way. So before it showed up in the data, as soon as the war began and the price of oil surged, I said I would not be surprised if we saw a significant deterioration of consumer confidence, which we then did see, and we better keep an eye on the inflation expectations, because a lot of times it has outside
lowest
impact.
Michigan numbers ever today.
Yep.
But if you raise rates, it's not going to open the Strait of Hormuz. It's not going to take tariffs away.
Agreed.
So is that a viable strategy at this point, or are you risking demand destruction?
Yeah, you are risking demand destruction, and you're just restating / rediscovering what makes stagflationary shocks among the worst things that a central bank has to deal with. Because if you face a negative supply shock that destroys employment and drives up prices at the same time, raising the rates doesn't solve your problem. Cutting the rates doesn't solve your problem. And leaving your rates where they are doesn't solve your problem. So the monetary framework that we passed unanimously, in it, we thought about, well, what will we do if we get shocks that are hitting both sides of the mandate at the same time? And we said, quite reasonably, we'll look at, well, which side is deviating more and how long do we think the deviation is going to last? I still think that's the reasonable way to think about it. But I would emphasize, as I say, the job market has been stable for a year and a half. The part that is deteriorating and what has moved me from optimistic about rate cuts to less optimistic is that inflation alone is getting worse. It's not even stalled out in progress. It's getting worse, whereas the job market has been stable. So I kind of think by the criteria we outlined in that framework review, it behooves us to take a serious look at what's happening on the inflation side.
Well, we assume a week from today there will be a new chairman of the Fed, and away from policy, in terms of policy making, there are changes he wants to make. Let me run through a few of them and see what you're thinking. One of the things he's concerned about is the dot plot and the SEP and the fact that everybody focuses on the median. Would you be in favor of eliminating or changing either one of those?
I could be. I mean, I'm going to be interested to see what, presuming he's confirmed as chair, I'm going to see what he proposes. I've written in past years about some dissatisfactions that I've had about the release of the dot plots and the ways in which it doesn't help to identify what the reaction function is of the committee. So I think that Kevin Warsh is going to come in with a lot of new ideas on monetary policy, on balance sheet, on communication, and those. I think it's good. Let's have some new ideas and think those through.
Well, the balance sheet, of course, is the big question. He wants to bring it down. There's a couple different ways you can do it. Do you think the balance sheet needs to be smaller? And if so, how would you go about it?
I don't know about needs to be smaller. Can be smaller. Depends in large measure how you conduct monetary policy. As you know, but in the older days up to 2008, we conducted monetary policy mostly through open market operations. Now we've shifted to the, as we call it, the ample reserves regime. We pay interest on reserves. That's a different way of doing monetary policy, and it corresponds with a bigger balance sheet than the old way. You could do it any number of ways, and like I say, it's not my position to weigh in and say I want us to do it A, B, or C direction. I'm interested in seeing what the new chair has in mind and evaluating that.